Most of us know him, but this is for those who don't know him. Because in fact, not only on this topic, he can speak on any topic of international tax and transfer pricing. In the last 17, 18 years, I have attended more than 50 lectures. And I have no hesitation in saying that we have learned transfer pricing as well as international tax with him. Not only on these such occasions, but also in our close group study sessions. That is close. So, with these words, before I request Ostwal to present his lecture, I would request Shri Manoj Shah to present a memento.
Thank you, sir.
Ostwal, the floor is yours.
Tarun Bhai, Manoj, Paresh, seniors in profession, ladies and gentlemen. It's indeed a privilege to be here with you this evening to speak on the subject on which I have already written a paper. And therefore it was not that difficult to accept this invitation. Possibly what has been told to me and what has been written as a title, there is slight difference. I was told emerging international tax trends. If you take this as a topic, then there is a very vast topic. And India's tax treaty policy. There are two topics. Whereas I was told it is one topic, Indian tax treaties, based on emerging trends of Indian tax treaties. Doesn't matter. As Tarun said, I can speak on anything. That is his presumption. I'll try to make a little bit attempt on deviation from what has been presented to you here. As far as international trends are concerned, you can see what is happening globally. OECD, everybody wants their importance in every forum. US is dictating their own terms. There is a huge agenda of pinning down the multinational banks, starting with UBS, and with a number of other banks. India is no less. We are trying to copy the agenda of the US. You have got FATCA coming in. India has signed the intergovernmental agreement very recently. So therefore, possibly the shift is, you may have to report if you are a banker or institutional investor or investment banker or the broker, taking any account of the American citizen, the resident or the green card holder, you first need to register yourself and intimate to your competent authority here in India, who in turn will have an opportunity to exchange the information with the competent authority in US and give all the information, share the information, which is a major development. Then you have the OECD grappling with number of issues, starting in all roadmap has been prepared, the BEPS, base erosion and profit shifting, and that is driving the world mad, because this is a roadmap created to be achieved in by 2015-16, and what will be the situation tomorrow of the world, nobody can predict today. Situations are now changing. The conventional thinking on the international transactions should be revised. You need to rethink various things, rethink various structures, and you have to redesign, revisit various issues. So therefore BEPS is one of the important development. Then the world is again talking about extensive automatic exchange of information. Now, information exchange as such has become very important subject. The countries are negotiating, and on the top of it, and this agenda, let me honestly tell you, India has been driving. We are the vice chairman of the peer review group of the various countries in the OECD. And we have tightened up number of countries in terms of their tax compliance and tax regulations. India, as a vice chairman of this group. To name few of the countries which we have been very vocal against them: Mauritius, France, Germany, US, apart from so many other countries. OECD has published matrix giving how many countries are fully compliant, how many countries are partially compliant, and how many countries are blacklisted. There are 4 countries which they are thinking they are not compliant. Luxembourg is one of them, Seychelles is another one. So these are the developments. In the light of these developments, and now G20 is meeting last week in Australia, they have concluded we should create a robust platform, electronic platform, which will automatically exchange information. And in any case, Indian Exchange of Information program is so robust. We have directed all the revenue officers to exchange the information with the competent authority of the other country of any foreign transaction beyond 5 lakhs of rupees. So this is the fate within which we are now living in. So therefore, cross-border transactions, if anybody is advising or doing it, one has to be extra careful. Barring that, I have no advice to make as far as international tax trends are concerned. These are all trends, which is resulting into change of the laws of various countries. We have blacklisted Cyprus. That was a signal given to other countries: don't fiddle around with us. Be careful. And I think we are trying to talk to Switzerland on these lines. Because we say, and possibly the advantage Switzerland has, the madam has an account. As a result, they can be only threatened. The threat cannot be actually resulted into an action. That is what is happening. So therefore, these are the realistic situations which we are all going through. Let's see, that brings an opportunity to all the consultants like you to really sharpen your tools and be ready with handling all sort of assignments and all sort of work. It increases your work, no doubt. So the software companies like TCS benefit out of this because they also get the opportunity to develop this robust technology. Some of the aspects which I have possibly kept in my presentation for the purpose of debate this evening is some very limited items, few I think 10-12 items. We need to understand in detail what are those issues. For the first time as a change, I have prepared a very short presentation so that you don't get confused. Generally, if I have to confuse people, I make a very long presentation. This presentation could have been 115-20 slides. Very easy. But I said no, we should not make life simple. So very few items. Item may be very few, but the debate and discussion on that could be unlimited. And the first and the foremost item is a tax pairing. All of you know what tax pairing stands for. If India taxes a particular income, if India does not tax a particular income under the domestic law, India does not want that income to be taxed by the other government. Why? Because if I give an incentive, and if that incentive is taken away by the other government, then what is the purpose of giving incentive to the taxpayer? We want to attract investment from foreign countries. We are capital importing country, and therefore we want investors to come into this country. So in certain segments, certain sectors, we incentivize, which hitherto used to be good policy, but now we have changed that policy. However, whispers are there in Delhi now, possibly they will have to rethink on the incentives. With a change in the guard in Delhi possibly going to happen in next 3 months, you will see the trend again going to reverse partially. There could be a reversal to the extent of incentivizing the investment that will come, and if it comes, it is good for the country because you don't expect people come and do a charity for your country. Everybody want to make money here, and if they make money only, then they will make an investment. Now the issue arises is, India was one of the signatory to the UN model in 1979 when we signed 1981 when we got the UN model. We were one of the responsible countries for developing UN model. When in 1979 OECD model was released first time, the India took an initiative to create a tax treaty group in the UN, and they immediately worked out the policy the developing countries wants to follow for the purpose of the tax treaties. If you look at the history of the tax treaty laws, in 1943, in the Mexico meeting of the various government, they decided that the source-based taxation should be the basis. There should be a concept of PE, there should be various concepts. In 1945, when the various governments, the developed countries particularly met in London, they realized this Mexico model will not help them. Because they are exporting countries, capital exporting countries, and if the developing countries start taxing them, it will be jeopardizing their interest. So they created OECD model thinking, and they said residence-based taxation should be there, which resulted eventually in a new model created by the by the OEC, which was formed in 1965, and then they set up that as an agenda. In the developed countries, they created OECD model, and 1979 that model was released, which gave rise to taxation on the basis of residence. And then India took the lead along with other developing countries. China was nowhere in the picture, Russia was not even bothered. So these two, India being a major country in the developing countries, had a very good tax laws, took the lead and said source-based taxation, which was talked about in Mexico model, should be the basis, and therefore they created a departure from the OECD model and they said, okay, let us have source-based taxation. And you look at the UN model, it says capital gains should be taxed at the place where the company is situated, where the person makes a profit. Royalties, fees for technical services, etc. Of course, fees for technical services has never been any model, including UN model. It is India's discovery again. So they said it should be taxed in the country where from the source of income takes place. When all this happened, and the reason for this happening, because if you look at the history, in 1976 June, we amended the law incorporating the provisions related to withholding tax on or the source-based taxation on royalties and fees for technical services. And then immediately we wanted that to be also adopted by UN, and UN created that. So we were talking about that, and then when we wanted to have the importing the capital, investors to invest in our country, we gave incentives to them, and when we gave incentive, we wanted other countries not to tax that. So therefore we started talking to all the countries. In the tax treaty model, there should be tax sparing provisions. Again, it was a discovery of UN model, and OECD model does not recognize tax sparing. Now, what happened? If you have been having, suppose you had a lunch by about say 1 o'clock, 1:30, and 2 o'clock you finish your lunch, and at 2:30 again you are offered a lunch. Would you like to take it? And a sumptuous, better lunch than the earlier lunch. Still you will feel, I am full. Maybe somebody may take little bit, 1 or 2 items. But nobody would like to take the lunch so quickly. So similar is the position today. Our tummy is full. That is what we believe. The government of India believes. We don't want to now incentivize anybody. We don't want to we will remove all the incentives, and they have been doing it. Maybe under the pressure of WTO, maybe under the pressure of various groups, maybe under various reasons. So we are fading out all the incentives from the income tax law, and therefore there is no incentive left for us to bother of the tax sparing provisions in the treaties. When we don't give any incentive, why should we have a tax sparing principles? But that is a myth, mirage. There is no guarantee that what will be the development of this country. The way in which monies are scoundreled, monies are taken away from this country. There is no development, there is no reduction in inflation taking place. Supply side is not getting addressed because monies are not used for productive purposes. They are just washed away from the shores. And if they are utilized in the production and the supply, automatically inflation should be under control. And because of that, now we believe we don't need a tax sparing, and I am personally of the opinion, sooner or later, we may find it again. However, what has got to do with the tax treaties India has? India has been advocating this policy that we don't want tax sparing. In UN forum, also this was debated, but because lot of developing countries still are not at the even a midway, They are insisting that tax sparing should continue. And therefore, India is now an investor in those developing countries. And therefore, if the other developing countries want tax sparing provisions in their tax treaties, you cannot deny that. We are trying to negotiate with the developed countries, but developing countries still the tax sparing provisions continues. We have not been, the trend doesn't seems to be so clear that India has been able to convince everybody that we don't need a tax sparing. I have seen the recent treaties India has signed. We have a treaty with UK which had a tax sparing provisions. We have renegotiated the treaty, but we have not abolished the tax sparing. It continues to be in the treaty. Despite the fact that we have tax sparing, objections to the tax sparing, one thing which I must tell you, India does not have extensive and explicit regulations on tax credit. Section 90 and Section 91 are the only two sections which gives you tax credit. And therefore, when it comes to Section 90, it is giving you tax credit country by country. Because it is under each treaty you have to look at the tax credit. When it comes to 91, possible view is that you can create all the taxes together. Nevertheless, the section says you have to look at the taxes paid in the other country and then give a credit. A section is silent whether you can club all the credits together, etc. when it comes to non-treaty countries are concerned. Now, when we do not have stated policy on the tax credit rules in this country, how are you going to deal with the tax sparing issue is a major issue. For example, in UK, if you are doing activity, along with those activities, if you undertake research and development, the government of UK gives you an incentive. They don't tax your profits. But if you are suppose doing this activity as a branch in UK, research and development activities profits are not taxable. And if that profits are not taxable and then you get back that profit by way of branch profit here, and India taxes that profit, what is the advantage of R&D's credit given by the government of UK? And that R&D credit is available even in the software sector. And therefore, a lot of software companies of India are enjoying that tax exemption under the R&D credit in UK. And if that R&D credit is getting taxed, there is no clarity whether, and this was matter discussed with the UK, the Indian authorities. They says we will not give any tax paying credit in India. We have been able to make out a case that R&D cess, R&D exemption is akin to a tax exemption in UK, and therefore the tax paying provisions should apply to us. Unfortunately, the Indian revenue authorities do not agree on this particular proposition. If you look at the trend, new treaties India has been signing, some of the developing countries treaty also do not have tax paying, Ethiopia, Nepal, etc. And therefore the point arises here, what is India's policy on tax paying? I have given an example of UK treaty, we have got a tax paying still continuing. The other treaties, new treaties signed, tax paying does not exist. So there is a complete chaos and confusion as far as when I talk to the tax authorities in Delhi, they say it is not our stated objective to have tax sparing provisions in the treaties. I said if the situation like 91 happens, India has to say, pledge its gold and borrow the money. Would you not then allow some incentives to go on? He says, I don't think situation of that nature now will come up. And in case it comes up, we will see how we have to handle it. So this is what the confidence we have on our system, on our ability to handle the finances. The next issue is India has now become the India has become an enhanced observer of the OECD. A poser which I had put it here, and the issue which is for our debate is India has been taking a position, judiciaries in India has been taking a position that OECD, we are not members, we will not go by the explanation OECD has been giving, and we are not bound by it. Whereas in some cases where it suits us, we say there's nothing wrong in following the OECD commentary, and we follow that. The trend is a mixed as far as judiciaries are concerned. And look at the Indian experience. We are now having become an enhanced observer of the OECD membership. We are not ready to become full member of the OECD, let me tell you. India has expressed its reservation to become OECD member, And in next 10 years at least, I can guarantee you, India will not become member despite the fact that OECD has been luring India to be its member, full-fledged member. Advantage of full-fledged member is you are in a position to direct, or you are in a position to veto, or you are in a position to vote against a particular policy of the OECD. But interestingly, despite the fact that we are not the members of the OECD and we are enhanced observer of the OECD, India has been playing a more important role than the OECD members. We are in a position to dictate. We can say that in case if you are not listening us, we will get out. We will not be interested in continuing even an enhanced observer. And as a result, if you look at today's recent working parties, all the drafts which are coming up from the OECD, India's thinking is really changing them to think on various items of the OECD thinking. If you look at the BEPS agenda, the base erosion and profit shifting agenda of the OECD, India has been able to come out with so many issues like source-based taxation, source versus residence-based taxation, because today it suits even the developed countries to have source-based taxation to some extent. But they cannot openly say this very clearly because OECD, they are the members of the OECD and it is against the proposition of the OECD to have source-based taxation. But the chief of the OECD, Mr. Pascal, had openly admitted that there is nothing wrong in having a source-based taxation, and therefore those all countries have started rethinking on the subject. And if I can guarantee you, if India and China become full-fledged member of the OECD, the tables will turn. OECD will become source-based taxation treaty, and the UN may become at that time residence-based taxation. And this would not be so surprising. One of the examples comes to my mind is when we are not the members of the OECD. In 2008, when OECD model was revised, at that time India expressed its reservations on some of the clauses of the OECD, some of the commentaries of the OECD. And India's reservations were almost highest number of reservations except Thailand. And therefore Thailand was not very significant, but India's reservations were major reservations on almost every aspect of the OECD treaty. And that really created ripples in the world. And one of the important reservations which was coming up in Article 1 and Article 4 was on the taxation of partnerships. India had said it very categorically that we do not believe in the transparent entity concept. In case if you are following the transparent entity taxation policy for the partnership firms, we will give benefit neither to the partnership nor to the partners. OECD wanted the benefit of the tax treaty should be granted to partners in case if you are denying the benefit to the partnership firm on the ground that the same income gets divided amongst the partners and the partnership firm is not liable to tax because of the conceptual thinking in those developed countries. For your information, I can tell you 90% of the treaties, the countries in the world follow the transparent entity concept as far as partnerships are concerned. Only 10% of the countries like India, Belgium and some of the countries follow opaque concept of the partnership. And therefore, when it came to the partnership, India said it very clearly that we will not give the treaty benefit either to the partnership or to the partners unless it is expressly agreed in the tax treaty. Despite the fact that this was our policy and that the immediate victim of that policy was India-UK tax treaty. And despite the fact that we had this reservation, we were giving the tax treaty benefit to the partnership of the USA. Reason being, if you look at the US tax treaty India had since 1989, we had made it very clear that the treaty benefit will be extended to the partners in case if partnership comes up a transparent entity. However, when it comes to UK, India had a treaty specifically, 93 treaty, in which we had said it, and this was accidental, intentional, by design, nobody knows. When I talked to the competent authorities of UK, he says it was by specific design. Whereas when it comes to the Indian tax authorities, they said it was a slip on the part of the UK. They have agreed for such a clause. Our intention is literal, meaning we don't want to give the benefit of the treaty to the partnership. What was the problem was If you look at the definition of a person under Article 3(1)(f) of the India-UK Tax Treaty, the definition included person to mean partnership of India, but does not include partnership of UK. Because they said partnership of and UK authorities said why we did not include, because we know in UK partnerships are not taxable. They are transparent entities. But then they did not go further to say where partnerships are transparent entity and not included in the treaty, the benefit should be extended to individuals who are the partners and who are resident of UK. And that created major issue in India, and that issue brought number of tax issues, particularly the law firms which are operating internationally, globally advising, and Linklater was one of the major victims. Of course, the tax authorities did not wake up in time. Clifford Chance got out earlier in the first 2 years. Similar problem happened with other shipping partnerships, which are major partnership, and the major disputes are pending in the Calcutta High Court, and MAP proceedings in respect thereof were also denied by the Indian authorities. They are not taking up those MAP proceedings when it was invoked by the competent authorities of UK and Netherlands. And that is one major area which was finally India said, as per our written policy, we do not want, on the OECD model, we do not want to extend that benefit to the partnership firm or partners. Surprisingly, recently in 2012, India revised its tax treaty with UK. And in UK tax treaty recently revised, which has been notified again recently, which is now effective, they have said the benefit of the treaty will be available to partnership of UK. And therefore, partnership in the sense, this is in case if it is transparent, the partners of UK. So what is the policy of India? When it comes to UK, now we are giving the benefit. Does it mean for every small reservations like this, you need to sign the treaty with every treaty partner? We have 90 treaties. After UK treaty, we have not even clarified this term with Australian treaty, Nepal treaty, Ethiopia treaty, and very recently we signed in 2014 one treaty. We never clarified this issue. Does it mean that those partnerships will suffer taxation in India? If you look at the advanced ruling authorities of India, who has given a ruling in the case of a Swiss partnership firm, they said they are liable to tax. No treaty benefit cannot be granted. You have tribunal decisions in the case of a German partnership firm. They said because German shipping company pays a trade tax is one of the taxes covered under Article 2. Therefore, the partnership firm pays the trade tax, whereas the partners are liable to tax. Partnership firm is not liable to income tax. Still, the treaty benefit is available because trade tax is one of the taxes covered. Where shipping company. Then we have Linklaters, where the Bombay Tribunal took a very holistic view, saying that the treaties are to be interpreted for the purpose for which to eliminate double taxation. And if the elimination of double taxation is objectives, then you must understand and interpret the tax treaties which will give benefit of the treaty, and therefore if you do not give the benefit to the partnership firm, partnership must be given the benefit. So you have very forward-looking the tribunal decision, and we have the backward-looking advanced ruling decision. My experience is advanced ruling and the tribunals are on the loggerheads. They always want to show that they are superior and they give different views. If the tribunal had given one view, advanced ruling will give another view, and vice versa is the situation. Be that as it may. So therefore, we have the problem as far as partnership firms are concerned. And the recent trend, as I said, I see this is to be a major challenge. How do we as professionals apply the treaty provisions? Can you say a partnership is a resident? Can you say the benefit should be granted to partnership firm or the partners? And that is a confusion which is really haunting all the professionals to take a very major call what should be done. And the same will be the fate of LLPs. If you are going to say the partnership, LLP is also on the same footing, and therefore that issue would arise: how do you deal with the LLPs? Because now today the world has got the major concept of the corporate entity, and that is LLPs, and India has also got the concept of LLP. India does not see any problem because the other country gives you the tax treaty benefit, and whereas the other countries see India as a problem because we don't give the tax treaty benefit. So this is the second major issue. I thought I'll just share with you some of my experiences, and with this let's go to the next issue. on that. If you have got any questions, you can deal with those. I can deal with every question only at the end. It is better that we don't disturb the flow. Otherwise, I am quite convinced that within the time allotted to me, I will not be able to deal with the whole subject. I can go on for any number of minutes on this every topic. It's better that let me finish the subject and then we take up the issues, and I will do justice to everything. The treaty application and the tax residency certificate. Now India, as all of you know very well, because we must be, half of you must be certifying international payments going out of the country. One of the requirement, if you want to apply the tax treaty provisions, you need to find out two things first: whether the recipient has PAN number and whether the recipient has the tax residency certificate. Hitherto, various interesting practices were followed by the clients. Clients would come and give us a certificate of incorporation, certificate of registration, certificate of sales tax registration, certificate of GST registration, and we used to say that, sorry, this doesn't work. You have to get the tax residency certificate from the tax officer duly certified. They say we don't understand the concept. And it was the stumbling block, it was a major problem between us and the clients. Eventually, the government of India realized the professionals' difficulties. How do they certify? They brought in this concept under the treaties and under the income tax regulation, under the law itself. Now they have made it mandatory that you must have tax residency certificate if you want to invoke the provisions of the tax treaty. And tax residency certificate, you know, sometimes it is like a pendulum. You have extreme position and the revenue takes another extreme position. We brought about the tax residency certificate with all those difficulties and strings attached conditions like now we have got in rule form 10F, they were forming part of the treaty. And then the issue arose. When the law was amended here, the issue arose. World over the country says, what nonsense, how you impose on us to give a certificate of tax residency in this manner, asking us to certify so many things which are not in our regulations to certify. We can give you a certificate whether he is a resident and what is his tax identification number, if required, blah, 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 nothing else. Some of the countries are more sophisticated in giving tax residency certificate, particularly if you look at USA, they have extensive rules for giving tax residency certificate under their regulations. They write the name of the firm, name of the partners who are that country's resident, and they say these are the people, the tax residency certificate is available to them. Some of the countries are very crisp about so many things. They don't understand the tax residency certificate. Some of the countries, despite the fact they understand, there is no willingness to give tax residency certificate. Some of the countries, the experience shows huge cost of getting tax residency certificate. For example, you go to UAE and you want a tax residency certificate, the UAE authorities are very happy because they charge you very fat fees for giving a tax residency certificate. Apart from that, consultant also has a new job of getting some certificate, which hitherto was not known to them. So they also charge for a heavy price. So therefore, you have to pay huge money for getting those certificates. India is one benevolent country where all these things are freely available. You can get it freely. Either get it or don't get it. Because India does not have rules as to how the tax residency certificate should be granted to the resident taxpayer. That, let me tell you, there is no mandatory requirement. When we applied for one of the companies, large companies, director's tax residency certificate, because he was getting director's please from a particular country, the revenue officer denied. He says, where is the law? Where is the law here? Why should I certify? Here, I said, in your appointment letter, has it been written that you must come to the income tax office and breathe every day? If there is no written, it is not written, why are you breathing here? Stop breathing. There are certain things which are natural, inherent part of your duties, and therefore it is necessary for you to certify. And the man was not ready to certify. Finally, I had to bring this attention to the commissioner. Commissioner directed him to issue the certificate. And then matter happened. Very interesting experiences happens. At times I can share with you some of them. I am deviating here and there. In one of the taxpayers' case, he paid huge capital gain tax because he sold his all hotels in Japan. And he paid capital gain tax in those countries. And he wanted to get a credit for those taxes paid abroad. In India, while he returned the capital gain because he became resident. And when he returned the capital gain as the income arising in Japan, against which the tax rate of Japan was higher, so he claimed the full credit. So the tax was not payable in India. But you have to compute the tax and then take a credit and then say nothing is payable. When he did this, the tax officer says, tax credit not granted. Why not granted? We came to know much later. Before we went to ask him, he says accounts are attached. Why accounts are attached? Sir, you have not paid the tax, there is huge demand against you. Demand is on account of what? Capital gains which you have not paid. The capital, I said, how you are taxing that capital gain? I already paid the tax in Japan. We can't give you credit for the taxes paid in Japan here. I said, why? Form number 16 not available. Form number 16 from Japanese tax authority. Such a funny thing, I enjoyed my experience. And my client was a very high profile journalist, and he said, write a very nasty letter to the commissioner. Very, as much nasty as you can, I'll pay better price for it. And if that, based on that letter also, if they don't act, I want to get it published in the newspaper. I said, excellent, if you are telling me to do, my job is to get instruction from the client. He wrote very nasty letter. And he made it further nasty. He was a journalist. Then based on that letter, I went to commissioner, who ultimately became member of the board. And she was with somebody. I sent a letter in between, seeking an appointment. She read the letter. It took 10 minutes to call me. And then she read the whole letter and she ventured not to call me. So she called her headquarters and told her, look, this gentleman is waiting outside. Take him to the additional commissioner, and I am directing him on his application what he should do. And I am speaking to him. Take him very quickly. So the lady came with me. I went to the additional commissioner and she gave this petition of mine to him. The lady did not acknowledge from the commissioner's office. But message had already gone to the additional commissioner that what he should do. He heard me, he listened, he saw me, and he offered me first of all a cup of tea, because by that time commissioner had already communicated with her, offered first cup of tea. He said, pacify. And having had a cup of tea, he said, sir, what happened? I said, you are first of all not giving me credit, then attaching my bank account, and then making my life miserable. You expect me not to spare you? Your officer, I don't want to spare now. Let me also make his life miserable. He says, sir, don't do it. He called the officer. He says, please rectify this. There is some paper which they have submitted, duly certified, notarized copy from Japanese taxes. He says, yes, something is there, but form number 16 nahi. He says, under which provisions of the law you need to have form number 16 under the treaty? Have you known the treaty? Sir, I don't know anything. If you do not know, why did you not ask us? Sir, but everything we do is, we don't ask everything. Finally, he says, you give the credit immediately and lift the attachment forthwith. These are my instructions, and the instructions are because of the commissioner's instruction to me. The fellow said, but sir, you have sanctioned my leave in the morning. I am just now leaving. So I can't do this today. He said, your leave is cancelled. This is the letter. And the fellow had then perspiring and saying that, okay sir, but I don't have a steno today. I can't give him this letter. He says, come what it may. You can type, you type. You can write in handwriting, can you write? He says, yes. Handwritten letter is good enough. Write a letter and give credit and lift the attachment even by handwritten letter to the Bureau of Bank. And the poor fellow had to do that. And my job was simplified. Of course, the letter which was written, they did not take it and they accepted and corrected everything. The issue is, at times you have to challenge. And if you just don't challenge, things don't work. These are the few experiences which really matters at times. And at times, for example, in one of the recent utterance, we were one of the DITs, this year's experience. I'm just sharing with you some of the deviation. It's a tax treaty policy and the tax practice policy you should have. When we were given a show cause notice of making an addition of for a small company, 40 crore rupees addition, on account of transfer of shares of a Singaporean company to another Singaporean subsidiary held by Indian company. They said, you must value the share by discounted cash flow method. I said, yes, we have done that. And we have given you the discounted cash flow valuation. The value which we arrived at was $19,000 per share. They said, no. Our working shows it should be $45,000. Okay, $45,000. How did you work out? I don't have any basis to work out. My commissioner has given me working and I am giving it. The officer gave us very candidly told us. I said, fine. We strongly objected to that and we said we want to have a hearing with the commissioner and the director. So we went and had the hearing with the director. It was precisely the case reversal of the Shell and the Vodafone's investment in India. It was reversed. And there is a tribunal decision of the Chennai Ascenda's case which deals with the subject of discounted cash flow. When I appeared before the commissioner at DIT, I said it very categorically. First thing on his face, I said, you are a chartered accountant, I am a chartered accountant. I know how to create such blunders, making 18,000, 19,000, 45,000. Very easy. You don't need a brainer to do all these things. 4 alpha, betas, etc. you have changed it and you have worked out this. 4 assumptions you have made it and you have changed it. When there is no basis for those assumptions, whereas my working is on a realistic, actual basis. So if you make such a stupid things, I uttered this word, if you make such stupid things, any stupid fellow on the world will be able to find it out. And if that be the case, I have not come to take a relief from you, but I have come to tell you that these are the howlers which you have created. You carry on with this, I will defend my client fully. No problem. And I am walking out from your cabin. This is very, I think this is very shameless things to have done such a thing. I have no problem in telling you this. Mr. Ostwal, please cool down, sit down. I said, what is there to cool down and what is there to sit down? What are you? He says, explain me which are the 4 things which I have done. Show me that and demonstrate. I demonstrated what you have done. 1, 2, 3, 4. And in the discounted cash flow presumption, first fundamental presumption is everything has to be discounted. Even the remainder value of the asset left, you have to discount it. Yes. I said, you want to take the full value here. Very simple. Everything will go change. The working capital average return on the capital employed will undergo change if you make a different presumption without looking at the actual, because the 2 years are already over. When 4 things were pointed out, he says 2 are acceptable. That will bring down the rate substantially low. I said that is not an acceptable. I told you first thing, I have come to tell you what mistakes which you have committed. I have not come to take any relief from you. Give or not, I don't care. But this is one show cause notice and which will result into an order. I would wish that you make it 420 crores rather than only 42 crore addition. I would get an opportunity to showcase this order in all international forums, including Indian forums, and make a mockery of this order and your order, and particularly making the name of the person drafting an order. And he got such a, furious looking at me. He says, Ostwal sahab, aap chhod ke jaiye representation. What is to be done, let me apply my mind. I'll call you tomorrow. Next day, he called me, he says, I have passed an order in your case, accepting whatever additions whatever report which you have submitted was final. I had no additions made in your case. I said, great, thank you very much, but I wish similar should be the experience others should have from your office. But you see the friends, at times it is necessary for us to take a position for a client, even whether it is liked by us or not. The realistic position, we have to put ourselves into the shoes of the client and think really what is happening is acceptable as a client to you. And if that is the case, you can do a justice to the job. The next issue is this TRC. The issue recently, my experience is, again, the officers are reopening the cases of the past years and saying that in the earlier year you have not provided the TRC. That is the only grudge. And because of that, the treaty benefit is not available. And because of that, the withholding tax done by you is at a lower rate, whereas the tax liability is higher. And therefore, we want to issue notice under 201. And in some cases, withholding is lower because 48(1) will apply, or 40A will apply, or 1A will apply, and therefore disallowance. And this is a retrospect. TRC is introduced only in the last assessment year, whereas now you get the orders for the earlier reopening. That led me to think whether this is a machinery provision or the computational provision. It is a provision which is required for computation of the income, and therefore it is a computational provision and not a machinery provision. Had it been simple machinery provision, possibly it would have applied retrospectively. In my opinion, it can't be applied retrospectively. That is not my personal view on the subject, and therefore that brought me to this subject: whether should we bring this issue to the public at large. TRC, people think, is not a very serious issue, whereas it is a very serious issue. Number of countries do not have concept of issuance of TRC. I have experienced this myself. We have a list of 13 countries which don't give TRC. And despite the fact you are telling them to give the TRC. And therefore, how do you deal with this? Issue was, when the TRC regulation was brought in the Act for the first time, I brought it out to the attention of the revenue in Delhi, saying that this is the form not acceptable to Singapore, Kuwait, other countries. And that made to them revise the language of this TRC, and they said, okay, we will make that other conditions in the TRC self-declaration. Experience shows, when you are receiving revenue, I teach in some of the universities abroad. When you teach universities abroad, they give you honorarium. But nevertheless, it is an income arising in that country, and therefore they want to tax that income. But they say, if you give this declaration, you give your particulars, you are resident of this country, then as per the treaty, it is not taxable. And we give the simple plain paper information with signature. It's a self-declaration. There is no declaration also. Like in India, I say whatever stated above is correct, true and correct to the best of my knowledge and belief. Nowhere in the world it is short declaration like that. We merely say, I am a TP Ostwal, resident of so and so country, my address is there, that's all, signature. You get a full payment without deduction of tax at source. So what is so sacrosanct? Now with the automatic exchange of information world over, India has been propagating, and the countries are being asking for, if you think that somebody has defrauded you from taxes by declaring a wrong TRC, why don't you use your machinery? Why do you want your job to be done by us? Self-declaration, this declaration, that declaration. We have been certifying so many forms, Form 3C, B, CD, etc. How many of them are accepted on the face value? Investigations are going to take place on those. So therefore, this is one area which requires really serious consideration as far as from our side. And the point is that the authorities or the organizations like Chamber, the chairman of International Taxation Committee sitting here, should take note and make a representation saying that these are the really practical difficulties. If they find it is worthwhile, otherwise it's a job, no problem for professionals. I wish the India also charges some professionals, or some revenue income tax department charges some fees for giving TRC, so that professionally, when we get the TRC for the client, we can charge fat fees. Sir, we are getting you fees, but TRC otherwise is a difficult job. So this is one area of problem. Next issue is, when it comes to the tax treaties, there are terms which are used in the tax treaties which are defined in the tax treaties. Article 3 sub-article 2, Article 3 sub-article 1 defines various terms under the treaties. Whereas there are only 8 or 10 terms. And there are a host of number of terms which are not defined. The issue arises, what is to be done, what meaning should be assigned to the terms which are not defined in the treaty. Look at Article 3.2, which says any term not defined in the tax treaty will have a meaning as per the domestic law. Now this change in the tax treaty policy has taken place to that extent. Now new treaty says as per the domestic tax laws. Earlier it was as per domestic laws. Recently India has started signing the treaties with as per the domestic tax laws. The issue for consideration is which tax laws? I am presuming income tax law. But in income tax law also there are a number of terms which are not defined. Or some terms are defined for the purpose of a particular section. Then which meaning has to be taken? The tax law giving a specific meaning for a particular section may not be a definition clause under the tax law, and therefore it may have a restrictive meaning. Like if you look at section 269 UA, immovable property definition, which has a limited meaning under that section. It has a particular purpose for which the definition was included. And therefore that definition you cannot import for the purpose of whole income tax act. And this creates a problem. I am reminded of a Supreme Court decision of Canada in this connection, and that is Queen Majesty versus Melford. In that case, the matter went up to the Supreme Court of Canada a treaty issue between Germany and Canada. And in that case, what happened? German treaty with Canada did not have the definition of interest to include guarantee commission. Indian definition now has interest definition includes all incidental charges. Similarly, section 228A interest also includes all expenses incidental to, and therefore guarantee commission obviously will be part of that. But now the issue is, when there is no definition of guarantee commission, neither domestic German law nor Canadian income tax law had the definition of interest to include guarantee commission when the treaty was signed in 50s. This dispute arose between Germany and Canada. Canadian company wanted to pay guarantee commission to a German bank. The issue arose is whether this guarantee commission is an interest, and if it is interest, withholding tax applies. If it is not interest, withholding tax will not apply in absence of permanent establishment. The issue arose is Canadian authority took a view. This is an interest as per the definition, today's definition in 1980 or 79, when the payment was being made. And therefore, the principle which was followed in interpreting the tax treaty was ambulatory principle. There are two principles based on which tax treaties can be interpreted: ambulatory and static. Static principle means the principal interpretation of the treaty based on the law prevailing at the time of signing the treaty. Whereas ambulatory principle means the treaty to be interpreted as and when the law gets evolved. The OECD commentary now today has changed the meaning, and therefore look at that definition, look at that meaning and apply that to the old treaty. Recently, Supreme Court of Mexico has taken a view. If the OECD changes its commentary, we are not concerned. Though we are a member of the OECD, we will apply the new meaning to the new treaties or those years' treaties, but old years will be governed by old explanation. Look at very interesting, same treaty, no change in the language, but in different years, different application. Because commentary of the OECD has undergone a change. And this is what is evolving world over. It is not something which happens only in India. It happens everywhere. And therefore, if you look at today, which meaning of the interest you should take, when it came to the Canada, they took the meaning as per the law prevailing at the time of payment, whereas German tax department disputed that. Matter went up to the Supreme Court of Canada, and it was argued, you have changed your internal law, income tax law in Canada to suit your convenience, which has an effect of overriding the treaties, which you cannot do it. You cannot override the treaties unilaterally. And therefore, if you want to override the treaty, sign a new protocol. Get it signed by both the competent authorities. Having not done that, you cannot override, and therefore meaning will be given as per the meaning given at the time of signing the treaty, and that will be no guarantee commission will not be an interest. And Supreme Court of Canada confirmed it. Supreme Court of Canada said, yes, what is argued is correct. That brought an issue before Canada, and the Canada brought about a new Income Tax Interpretation Act in 1984 to override the Supreme Court decision. It is not that in India it is only done, everywhere it is done. Crows are black everywhere. So therefore, it is done everywhere like this. Now, friends, the issue is a term not defined in the treaty. How it is context, in what context it is relevant. Look at 2008 notification India has issued. The word may be used in the treaty shall have a meaning as per the notification it gives. It means the resident of the contracting state will have to take that income arising in a foreign country and include it in his income tax return and pay the tax in India. The controversy arose because of the Kulangan Chettiar's decision in the case of Supreme Court 207 ITR, in which Supreme Court said an Indian resident earning income from Malaysia is liable to tax in Malaysia because income from immovable property may be taxable in Malaysia. Malaysia has not taxed that income because it was an agricultural income. Like India, Malaysia was an agricultural nation, so they have exemption in their country. So they say agricultural income may be taxable, means we are right to tax, but we are not taxing because we are promoting the agricultural, we don't want to tax agricultural sector. Indian authorities took a view, may be taxable in Malaysia does not mean they only are entitled to tax, we are also entitled to tax. And that was the officer's view, which was negated by all authorities from Commissioner Appeal to the Supreme Court, all, without exception. But Supreme Court and High Court gave the same exemption for different reasons. High Court in Madras took a view, may be taxable in the other country should be interpreted to mean shall only be taxable. Whereas Supreme Court said we don't subscribe to this view, may be taxable, it means shall only be taxable. However, whenever the word may be taxable is used in the treaty, they are more liberal. They said whenever the treaty gives the right of taxation of a particular country without corresponding right of taxation of the other country, and the word used is may be taxable, it means the sovereign right of taxation is given to that country. Whether that country wants to tax it or not is their choice. And therefore the other country cannot tax it because other country's right of taxation does not exist in the treaty. You look at number of tax treaty articles, interest, dividend, royalties, we have both the countries' right of taxation given. It says the income is permanent establishment. Income is taxable in the country where the permanent establishment exists. However, it is also taxable at the head office. First of all, it is a reverse way written like that. Income from business is taxable at the place where the residence of the company, where the residence of the person is. However, such income shall also be taxable at the place where the permanent establishment is there. So it is a reverse way of putting. Both the countries' rights are explicitly stated. Interest will be taxable at the place of residence. However, the country of source is entitled to tax at a lower rate, 10%, 15% as the case may be. So both the countries' rights are specifically mentioned. But OECD does not agree with this interpretation. Kulangan Chettiar has given. OECD, and in fact, Kulangan Chettiar literally reduced all the exemption, all the credit method treaties to the exemption method. This was another extreme. And that was really beautiful. It happened in 2005. Government of India took 3 years to amend the law. And in 2008, we notified that the word may be taxable in the treaty shall be interpreted to mean shall the India has the right of taxation of the income of a resident. Non-resident, we don't want to tax it. The issue arises for consideration. If a non-resident's permanent establishment in India gets similar income from the other country and he applies that country applies the treaty of his own head of his country and says maybe taxable word, what will happen? God only knows. That such situation has not yet come in. But leave that aside as it is. Don't bother about that amendment. After that, in 2012, if I am not mistaken, or 13, the government of India gone really across the board further. They say section 90 subsection 3 now we have amended. The term not defined in the treaty will have meaning as per the notification, and such meaning given to the term not defined under the treaty will have the meaning from the date when the treaty came into existence. It means retrospective. Can you have such an interpretation unilaterally? Now, Indian tax treaty with Malaysia was revised in 2001, and the Malaysian treaty was a cause of this problem. 1981 treaty was a cause of problem, and now 2001 treaty was the factor the government of India considered and amended the law and issued the notification. Supreme Court gave the decision. The issue arises for consideration. What should we do in a situation like this? The more confusion is coming now. India signed the treaty with Malaysia very recently, new treaty, 2013. And in that 2013 treaty, in protocol we have said, the term may be taxable wherever used in this treaty will have meaning India has a right of taxation if the income arising in Malaysia. So we have defined this term in a protocol in Malaysian treaty and exerted our right of taxation. In the domestic law, we have exerted our right of taxation retrospectively. This treaty comes into force only in 2013. But before that 2013 amendment brings us to taxation from 2001. Now the issue arises for consideration is, this is under the domestic law as well as under the treaty. How will you take such a meaning arising on account of the term maybe in other treaties? India has not yet changed the terms maybe means this is taxable in India. And therefore, if you have used the term maybe as specifically defined in Malaysian treaty, treaty is ultimately what? Is a contract between the two contracting states, negotiated, taking into account various gives and takes. It's an ultimate negotiated document. And therefore, I can't say that other treaties will also have the meaning as per maybe, notwithstanding what you have said. Then again apply the Canadian Supreme Court here, theory. The term which was not defined in your domestic law, retrospectively you are bringing about this change. Will it be binding on me? Answer is clearly no. Other treaty partner may dispute that. Interestingly, we have a decision of a Bombay Tribunal in the case of TISCO. In 1979, in 1984, India's tax treaty with Germany, earlier treaty was amended. And that earlier treaty was 1958. When the treaty was amended, it was amended in 1985, retrospectively from 1984. And they said the treaty is amended treaty will apply from assessment year 84-85. TISCO challenged it. TISCO said, how can you apply treaty retrospectively? What happens to my existing contracts for this assessment year 84-85? I can understand 85-86 onward it will apply. We will pay the taxes accordingly. But what happens to the existing contract for 84-85? They cannot be taxed. And the Bombay Tribunal accepted the proposition. When the law treaty was applied retrospectively, assessee has an option of applying whichever is the treaty, old treaty or the new treaty which is beneficial to it. And they will be governed by the old treaty and not by the new treaty. However, they said if new treaty is beneficial, assessee can apply for that treaty as well. And that has been the interpretation when UK did not notify the treaty. UK mistakenly notified Ghana Treaty, and Ghana Treaty was notified by Ghana 4 years later. And when they notified the treaty, they wrote to UK authority, we have now notified, please notify. But UK had already notified. UK gave benefit of doubt to the taxpayers. So that was a proposition. It leads to a number of issues, maybe taxable. Question which was raised in the recent ITAT decision in the case of SR Oil, which was argued before Bombay Tribunal by Mr. Dastur, that the term maybe is not a term at all. It's a grammar. What is Article 3.2 says, the term not defined in the treaty will have meaning as per the domestic law. Is the maybe an English term or is it maybe an English usage of a grammar? And he proved it is the usage of a grammar. However, the tribunal was not convinced. If you look at some of the dictionary meaning, there is no difference in the term and the verb, and therefore it will apply. It is a term only. But I had extensive discussion with Mr. Dastur, and he feels that this is a matter, such an important matter, it can be and it has to be challenged in the Supreme Court, and I have no doubt that this is a wrong decision. Let's see, the time is an ambulatory thing, we will also here see what is going to happen. PAN, I was told, is one of the mandatory requirement, and therefore when you apply the treaty provisions, you look at the PAN. In absence of PAN, you look at the provisions of section 206AA and apply the higher rate of tax, that is the tax rate as per the treaty, or the 20% whichever is higher. Though the section 206AA provides 20, 25 and blah blah blah, but effective reading of that section conveys the meaning that maximum rate of tax is 20% only. So therefore, if you apply 20% rate of tax instead of 10% rate of tax under the treaty, the taxpayer, the transaction cost becomes very heavy. In such situation, what do? We need to obtain PAN number. Now the issue is it not a case, there nowhere in the treaty it is defined, nowhere in the treaty it is written that in order to prove your case that you must have PAN number. PAN is one of the identification number, and the identification number is required to identify the payment has gone to a genuine person. Now you can do that by exchange of information. Why do you need that PAN number? Interestingly, my experience on this subject is again very different. Recently, we have been receiving requests from the clients from foreign country that they have received the notice from the tax department. In the last 4 or 5 years, they have been receiving remittances from India on account of royalty, interest, fees for technical services, etc. After deducting necessary taxes and paid into the government here, depositing with the government, and those remittances have gone to the taxpayers abroad. Now they have not filed the return here. They have been under the impression and presumption that the payer has already fulfilled his obligation of deducting and paying it to the government. The full tax has been paid. They don't expect any other liability, so they did not file the tax return. The notices have been issued to the taxpayer with the language which our tax department uses, so scary at times. Indians, we are used to now. I don't care for something. But the foreigners don't take this as a face value. They take it on a face value. They don't discount it. And they say, sir, if I don't file the return, prosecution, tax penalties, 10,000 rupees, what do? I say, 10,000 rupees less than $100, $200. Why do you worry about it? No, so we don't want to see any penalties levied on us.
And not to
Please.
depart.
Huh?
And not to depart from the country.
Yeah. And therefore, we do not know what are the other unintended consequences. Tomorrow they may sanction those who have not filed the return. Next time we will not allow you to. They may prepare some new list of the people who have defaulted. So we want to comply with the regulation. Kindly advise what should we do. I say file a return. Can you help us to do that? Yes, certainly, why not? What will be your fees? When you give the fees, very high fees. Is it worthwhile paying tax 10,000 rupees? I said that is what we advised you earlier. But you want to be on the lawmaker's side, comply with, pay the fees, what is the problem? And lot of taxpayers internationally are opting for filing a return and say that let us comply with the law. Let us not be on the wrong side of the law. And therefore these are the consequences. And the notice received as good as last Friday, saying that one of the German clients received a notice and the correspondence, email communications are going on. What do? We have been sending replies. But they said, let us comply with the law. So these are the issues which arises. It is very easy to say, and that is the reason if you look at the foreigners, I was not in a position to understand psychology. Why people should not apply PAN number and get the payment at a lower rate of tax. Why not they help the taxpayer who is remitting the money from India also to at least fall in the line to pay lower rate of tax, despite the fact that the tax liability is onerously taken by the Indian payer. The foreigners are not ready to cooperate and obtain the PAN number for the simple reason they said these are the unintended consequences which are expected to arise on the country like yours, which we cannot predict, and therefore we don't want to apply for PAN number. Friends, these are the issues which as a practitioners are beneficial to you. You must also look at carefully, but user-friendly language we have to use to the taxpayer so that at least we make their life happier and simpler. Next issue arises for consideration. One of the aspects I already dealt with is the partnership of resident. Article 4 of the tax treaty defines the term resident. Recent two tax treaties, if you look at, 2 or 3 tax treaties I will come to, is India-UK tax treaty, India-Poland tax treaty, India-Malta tax treaty, and fourthly India-Malaysia tax treaty. These are the 4 treaties worth really bothering about and really daunting. It's a big task thinking about it. The question now we say, the treaty says the person is a person who is liable to tax, is subject to tax. There is a difference between subject to tax and liable to tax. The treaty says he should be liable to tax on the global income in that country. Now some countries don't have a concept of global income taxation. Singapore, for example, they have a concept of territorial taxation. Hong Kong, of course we don't have a treaty, we are negotiating. Hong Kong is a territorial taxation. And for that matter, let me tell you, France and UK are also territorial taxation. And if they are territorial taxation, what happens to those people who are paying taxes in respect of income? They are staying in UK. For 7 years you can be non-domicile. And if you are a non-domicile, you will be paying taxes in respect of income arising in UK and not any other income. You have income from Switzerland, you have income from India, credited to your Swiss account. UK will not bother. The only condition is UK will say you bring that income to UK, you pay the tax. No territorial taxation system. Now in such situation, what happens, whether the India will give the treaty benefit to such persons, class of persons? In my opinion, if those countries give TRC, I don't think India can deny the tax treaty benefit at all. However, India had taken a very categorical position in Malaysian tax treaty and Malta tax treaty, where Malaysia has a territory which is considered as a tax haven. Number of countries have denied tax benefit to the Labuan. Labuan is one of the tax territory of Malaysia, which is a tax haven of the eastern world, Far Eastern countries. Korea was one of the first countries to deny treaty benefit, Korea-Malaysia treaty to Labuan. And now India woke up after a long time. Korea's denial was almost in the year 90s, and now we are talking after 25 years. The issue arises is, does it mean that, is it our stated policy that deny the treaty benefit to entities which do not pay tax in the country in which they are operating. And if that be the case, it has significant ramification, because if similar view is taken by the other country, what will happen to our SEZ, I myself do not know. And therefore, that will be an issue by itself. And the Malta tax treaty, Malta gives a benefit to shipping businesses, and therefore there is an act called as Malta Merchant Shipping Act of 73, in which shipping companies are not liable to pay taxes. Indian new protocol with Malta excludes such benefit to the Malta tax treaties as well. And therefore, India-Poland and India-UK treaties on a global taxation and the other treaties are these other examples worth taking note of and keeping our eyes and ears open while following the tax treaty, while interpreting the tax treaties. Anti-abuse provisions, which has become a fashion of the day. World over, everybody is now trying to pick up GAR, directly or indirectly, in a smaller or bigger form. India has gone by a very big form, which was stupidity. But nevertheless, I am quite confident with the new regime coming in Delhi, they will revise this GAR provisions. I have no doubt on that. Because the way in which we have gone GAR without application of mind, without thinking, just because Vodafone is one problem Supreme Court has resolved, let's catch hold of Vodafone, retrospectively amend the law. But without realizing the ramification of that retrospective amendment. It has unintended consequences of taxing so many entities which are not required to be taxed. So many type of calculations and so many difficulties. And in literal sense, when we are advising the clients on international operations, the difficulties arise because of when you want to do reorganizations abroad, that creates a problem here. Now, anti-abusive provisions. Recently, I have come across that India has been now adopting GAR provisions in the treaties itself. Look at India-Nepal tax treaty, India-Ethiopia tax treaty, wherein the treaty itself provides for the anti-abuse provisions. And therefore, the issue arises whether you have a treaty or the GAR under the domestic law. If the anti-abuse provisions in the treaties are very restrictive, can you apply those provisions against the Indian GAR? Would be another issue which will test it as and when required. The treaties have limitation of benefit article under the treaty, and this limitation of benefit article, India has been negotiating with every treaty in a different fashion. India woke up after the decision of the Azadi Bachao Andolan in 2003 or 5, and they said now India, the Supreme Court said, you want to stop the treaty shopping, bring LOB article. And in 2010-8 onwards, India started talking about LOB article in various treaties. And you look at the India's tax treaty, various tax treaties have a different languages. There is no consistency, there is no commonality, there is no basis of making any LOB article. Why do you want to give, why can't we have a treaty policy to have LOB article in a particular manner? Look at India's tax treaty with USA and US tax treaty with the world, rest of the world. It has been given stated policy of the USA not to sign the treaty with LOB article, without LOB article. The only treaty which was left having no LOB article is the Poland, and I am told they have already renegotiated the treaty which is not yet been notified. All other US tax treaties have a LOB article, very extensive article. Why can't we have one common approach? We have LOB article as far as Singapore is concerned, where the remittance is required to go to Singapore, or where the expenditure for the purpose of capital gains is 2 lakhs of Singapore dollar. Or look at the India's UAE tax treaty, very narrow LOB article but very extensive. Look at India's Saudi Arabia tax treaty, long article of LOB but not very meaningful. So therefore we have different LOB articles but without any policy. Now the issue arises is some of the LOB articles which have been of a recent origin, like India, Nepal, Ethiopia, they have a language that the GAR provisions also have been introduced. One of the purpose or main purpose is to abuse the provisions or to take the treaty benefit. Main purpose or one of the main purpose has already been defined under section 95 or 96 or 97 of the Income Tax Act under the GAR provisions, and therefore the treaty terms have not been defined, and therefore if the treaty terms are not defined, the meaning assigned under the domestic law section 97 in my opinion should prevail. Australia has signed a new protocol very recently, but we don't find LOB article in that treaty, neither GAR provisions in that treaty. Why? I don't understand. Because as I said, the treaty is a result of negotiation between two partners, and if the other partner is more powerful than he says we don't care, okay, alright. But Ethiopia and Nepal, I don't think they are so powerful. So they say, okay, alright, whatever you want to write, please write, we'll sign it. Like Cyprus, we have notified Cyprus. Now they are coming on their knees, telling us, sir, we are ready to sign the new treaty. The government of India says, we don't care. We will revise the treaty only when we feel it is necessary. Punishment continues. And that is going on. And I don't think by June or till October you will see any change in the Cyprus treaty. And however, very interestingly, let me share with you some of the thoughts. Despite the fact that Cyprus treaty has been notified as, one of the toolbox treaties, the revenue officers in Bombay are giving certificate. These payments are not liable to tax under section 115, read with section 94A, and therefore you are allowed to pay. How come? Very interestingly. This experience, I am saying, I am not giving you the names, but Bombay, I have said it to you as an enough indication that you have, I think people can purchase such certificates in Bombay. This is happening. And when it was drawn attention to Delhi, they said, how can you, my revenue officers issue such certificates? I said, well, you ask your revenue officer, we do not know. Beneficial owner article. India, this OECD has been debating beneficial owner. And there are international interpretation of the term beneficial owner. The RBS case of the French code has given a meaning to the term beneficial owner different than the OECD intended. For example, if you have a company and the company has paid the dividend can be purchased. A person who pays the payment of a dividend and purchases dividend coupon and encashes the dividend coupon because it is more favorable tax treaty, no withholding should take place, and that is, or exemption methods are available, and that is happening. And the French Supreme Court says, what is wrong about it? Now, India has taken that leaf out of that, and they have provided this so categorically, GAR provisions on the dividend article in the India-UK tax treaty, and therefore it matter worth noting thereof. I will not touch upon the rate of tax on the dividend. Recent trend is, we have been now signing the treaty with 5% withholding tax on the dividend. In that case, the issue arises is, can I must think out of the box, can I not apply the provisions of the treaty as compared to or as against the dividend distribution tax, which is as good as 17%, and challenge the tax authority's decision that I will not apply the dividend distribution tax. This is one important thing, because nobody thought that state tax in USA is also creditable unless somebody had challenged it. And people challenged it at times, and ultimately Bombay Tribunal took a view, state tax is also deductible in the Tata Sons case under section 91. And India has recently signed a treaty with Malaysia which says very categorically, periodically say after 10 years we will review the treaty. Though it is intended to be very noble cause that every 10 years we will renew the treaty, God knows, India-Korea treaty had Article 8, shipping profit, which was required to be reviewed. They never reviewed from 90s so far, and now they are re-examining new treaty. Exchange of information, which is now becoming an important tool. We are signing number of tax treaties. Another recent trend is India-UK has signed a treaty, tax examination abroad. You or a tax officer can go to UK and examine the taxpayer of UK, non-resident of the taxpayer of UK, along with the officers of the tax department of UK, as a new trend, and tax exchange information, etc., which is taking place. Friends, thank you very much for listening me patiently, and this is an appendix which I have given you for the purpose of information, and thank you very much. If you have any questions, limited time, I will deal with them. Yes, please.
A person has, he does not have a PAN number, does not have a TRC. The tax rate will be what, 20% or under section 195, 30%?
20%.
20%?
TRC is not there.
PAN is also not there.
Why under 115, 30%?
195.
Why? 30% because non-resident individual
Yeah,
or non-resident company.
individual.
Individual, why he should not have progressive tax?
You should not have.
if he's a non-resident, he's like any other Indian. There is no difference in rate of tax. Why 30% straight away?
For a non-resident,
What is the nature of income?
say professional fees.
Professional fees to a person who is a non-resident, generally you will apply 30% rate of tax under the domestic law. So if you apply domestic law 30% rate of tax, an individual where he has no PAN number,
And no TRC.
you don't need PAN number and TRC because 30% is higher than that rate. In any case,
No, so I'll have to deduct 30%?
you are allowed to deduct 30%. Even if you have a TRC and you have PAN number, what you will apply? Under the treaty also you will have to apply rate of tax,
Rate of tax.
and that is same 30%.
These foreign companies are now supposed to file their return of income. Whether this TP provisions will also be applicable? to
Obviously,
them?
yes.
So if they comply with return, then they have to comply with this also.
If the very interesting aspect in the TP is, if you are compliant on one end, you are automatically compliant on the other end. So therefore, you can use that same tax or other taxpayers' report and submit it. My opinion. And we have been taking similar view in the UAE. And OECD also support the same.
44 AB will also.
These are the grey area, 44 BB. The grey area.
In some countries, when you apply for TRC, they take sometimes 45 days and all to issue the certificate.
And this is the practical difficulties I have faced also.
So in that intervening period, what?
So therefore, when people sign the nowadays we tell the client, when you sign that document, in the document itself you provide agreement that you will furnish TRC. I take the liability to pay the tax in India, provided you get me PAN and TRC. And if you don't get PAN and TRC, then tax liability is on you. And at times it has worked. Then your liability to deduct tax at a lower rate is available to you. Otherwise, you are saddled with a gross liability, which is very heavy.
But at the time of, suppose if I am giving a certificate, at that time, TRC is not available.
You take a business call. If your client is, not seriously. If your client is very regular and he assures you that this is in the process of obtaining and there is sufficient time available, because the department will not come for scrutiny immediately. At times we have taken a regular call. We have allowed the payment to go because and then client gets us that certificate. We put it on record. There are some issues because it is after our certificate was issued. We said we have got an undertaking, the client is in the process of doing it. But at the time when the tax department inquires that certificate is available, what business you have got to now challenge it?
Sometimes this TRC is only.
This is again I said to you, you have to take a call on your client.
Yeah.
If your dealings with that particular person are regular and the client is very comfortable, not that it is a matter of an advice I will give to everybody that you follow this as an exception. No.
Sometimes
As a rule, no.
TRC is given for the year. Sometimes it is as on date. What should we do?
Very interesting. You look at the TRC, Indonesia insists. They say Indonesia want every TRC should be notified and notarized. They should be an original. I said, how can you get an original? Once TRC is obtained, obtained one. But they said, no, at least you will notify. No, notarize this. Every TRC you have to, now insurance and reinsurance businesses, whole transactions, the payment goes on for the whole year. How do you do that? Practical difficulties. But you see this, the revenue authorities world over, they are, crows, as I said, crows are black. Their intentions, more corrupt is the country, more will be such draconian regulations. And one of those countries which are covered by such example which I gave was India, Brazil, Indonesia. These are all corrupt environment, vitiated environment, and the procedures are bound to take long time.
So for every remittance form, you have to Thailand, you have to take.
No, this is what Indonesian practice is.
Local
I have given you a practice of one particular country based on my experience. You may have a limited experience. I may have limited experience. You may have more experience. But I am sharing my experience because I am told to share something. And by nature I generally share. I don't care about it. And I escalate these issues so that more and more people escalate similar issues. The life of Paresh Shah becomes difficult as a chairman of International Tax Committee, then he has no other choice than to make a representation on behalf of Chamber. You know, interestingly, Philippines gives the tax residency certificate to a branch of a foreign company as a resident of Philippines. Can you imagine? Everything is possible. I always keep telling people, keep your ears and eyes open and never believe that what you know is the only law. Somebody else can tell you, some smallest fellow, sir, this has happened. I said, excellent, absorb that and apply, try to apply in your practice in the future. Nothing is possible.
But if branch is treated as resident, most of the problems will be solved. Permanent establishment, permanent.
Now Tarun Singhal says even Singapore is issuing such certificate. If that be the case, please share your certificate to us. Then we will be joy, we'll be happy. Please, I will be delighted. Chamber should publish them without name basis. For the benefit of all the professionals, isn't it?
Yes.
Yes, please.
Filing the return of a non-resident who has obtained PAN in India just for say a few remittances, there are various issues in filing their financial statements, their P&L, balance sheet, their bank accounts and all. So like what is the view being taken or how do we do that?
Honestly speaking, I can't answer. Honestly, neither my office has escalated this issue because I don't file the return. I only look at the advisory. My office does it. Next time if you ask me this question tomorrow, I'll ask my office, how are you doing such problems? Please let me know so that I can share my. I am honest in confessing, saying that I don't even file my own return. I do not know how to file the return. My office does it because this is a technical subject, technical matter. And everybody cannot. And if I devote that much time on that, the loss which I will suffer will be magnanimous. If somebody can share the views, I'll be also delighted. Anyway, next seminar we will keep this subject. Yes.
So I think it might be a repeat of the first question which was being asked. If there is no TRC and no PAN, would it be right to say that the low tax rate, which is mentioned in tax treaty, would be overridden by the tax rate mentioned in Income Tax Act, but that too unilaterally? It's not a bilateral part.
This was my whole theme of lecture was that.
But sir, yes.
My theme of the lecture was that. Somebody has to challenge somewhere. The issue is we chartered accountants always believe in complying letter of law, looking very seriously and just filing it. Whereas lawyers generally challenge this as a jurisdictional issue. This is wrong. You don't have jurisdiction. And some chartered accountant recently adopted that style of challenging a smaller issues as a jurisdictional issues. So that the matter goes all the way up to Supreme Court and they earn, it is a milking cow, the client becomes their milking cow. And they earn fees, non-stop. That is also style. So depending upon how many clients you have, if you cannot cater many, don't bother about this. If you have very few, enjoy your life. Yes, please. I am sorry being very candid and forthright. Don't record.
So can I? So in Cyprus, if the remittance has not taken place, but interest has been accrued, TDS has been deducted, and now when you go for remittances, I mean, you cited about the Bombay office being issuing, what kind of reaction will be there? It is just a remittance. Should we regard it as a non-jurisdiction area, or since compliance has already been made, remittance should be allowed without any further deduction?
If TDS has already been deducted and now you are remitting the money, differential TDS has to be paid as of today. And we have done in one case. And the client says we will file the return once the notification is withdrawn and we will get a refund, we will give you. That sort of an arrangement was signed. Okay? Yes.
So just in this related matter, actually non-jurisdictional area, the section 94A, the wording reads similar to section 206AA. And 206AA, one view is taken that if there is no tax liability, then you do not need a PAN.
Here was a case where the tax liability was there.
So then, yeah,
No, where you do not have liability, you don't need a PAN. I agree with your views entirely.
Even for Cyprus payments, if there is no tax liability.
If there is no tax liability, section 94A is the same language under section. See, for example, in one area of payment, there is no tax liability, and the tax office giving in Bombay certificate was valid, in my personal opinion, and therefore it was made without any payment of tax. I reconfirmed that to the client, and client remitted the money. But on income part, we deducted tax.
We are just explanation 5.2, which says that income on, if it is considered on accrued basis, it will not be reconsidered on recent basis. There is an explanation.
No. Accrued basis, you have not remitted that money. Now this 94A talks of remittance basis. Remittance basis. Thank you, sir.
Good evening, everyone. Just a quick announcement for tomorrow. Breakfast begins at 8:30 a.m. and the first technical session will start at 9:30 a.m. Now to the pleasant task of proposing a vote of thanks to Mr. Ostwal. It's my privilege to have been asked to propose vote of thanks to Mr. Ostwal. I, on behalf of the Chamber of Tax Consultants and all the participants, extend a big thank you, sir, for being here today, sharing your immense knowledge and very, very interesting practical experiences with us. We've all benefited greatly by you being here today. It's always a pleasure to listen to you, sir. And as Tarun Bhai said in the beginning, that we wouldn't have had asked for a better speaker than you for this topic. Thank you, sir. I request everyone to carry out the vote of thanks.